Today, Australia's GDP surprises on the upside. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the ABS just released the gross domestic product, the GDP, for the June quarter. And a bit surprisingly, it rose 0.7% in seasonally adjusted chain volume terms. Some of the analysts were suggesting that we might be going backwards, but no, a slight rise despite all the lockdowns. And in fact, the ABS in their commentary said that domestic demand drove growth of 0.7% this quarter, which saw continued growth across household spending, private investment, and public sector expenditure. Lockdowns had minimal impact on domestic demand, with fewer lockdown days and the prolonged stay-at-home orders in New South Wales only commencing later in the quarter. Private demand contributed 1 percentage point to growth. Household spending increased 1.1% and added 0.6 percentage points to growth, driven by spending on services, which rose 1.3% as COVID-19 restrictions continue to ease across Australia. Private investment rose 2% and contributed 0.3 percentage points to growth, and dwelling investment increased for the fourth consecutive quarter, rising 1.7%, reflecting continued demand since the introduction of the Home Builder scheme. Housing activity continued to contribute to growth. Ownership transfer cost rose for the fourth consecutive quarter, rising 10%. Public demand contributed 0.7 percentage points to growth, driven by continued investment in state and local infrastructure projects, and government spending rose 1.3%, driven by health-related expenditure. Gross value added, or the GVA, for the health industry rose 2%, and of course that's directly relating to the pandemic. Net trade detracted from growth, driven by falls in exports of mining commodities, reflecting disruptions in both coal production and transportation of iron ore to ports. Mining operations surplus rose 16.9%, its third consecutive rise, reflecting strong commodity prices, and the terms of trade rose 7% in the quarter and 24.1% through the year. The household savings to income ratio fell slightly, but remains elevated at 9.7% as household spending rose and household income fell. Compensation of employees rose 1.2% as employment and hours worked increased with underlying activity in the economy. And a fall in benefit payments detracted from income growth, reflecting a decline in the number of recipients and the winding back of additional COVID-19 support payments during the quarter. So this is, of course, rearview mirror stuff insofar that now the lockdowns are hitting much harder and the iron ore price has dropped. So it's very likely that next quarter the growth rate will be significantly lower. But nevertheless, it means we have dodged a potential recession bullet, at least for a quarter. Now, just adding a little bit more colour to those numbers, the annual growth rate lifted to 9.6%, and activity is about 1.6% above pre-COVID levels at the end of 2019. The key surprise, which was actually not expected at all, adding 0.5 percentage points to the quarter, was other inventories, which accounted actually for 70% of the growth in the period. Public authority inventories rose, adding 0.35 percentage points, probably relating to the stockpiling of vaccines and other medical supplies, and farm inventories added 0.15 percentage points, which was significantly above what people thought was going to happen. The economy, therefore, had considerable momentum heading into the June quarter, and domestic spending expanded during the period. This reflected the reopening of the economy through to the second half of 2020 and into 2021, and the substantial boost from aggressive policy stimulus alongside an upbeat mood amongst consumers and businesses. Now, of course, stimulus has been withdrawn and consumer and business confidence has now waned considerably, so this may not be a good indication ahead. However, output in the June quarter was dented by disruptions as the COVID pandemic continues to impact. Those disruptions contributed to a substantial subtraction from net exports and from private non-farm inventories. And there were a number of snap lockdowns in response to COVID, and then the Bondi Delta variant outbreak from June the 16th, which then saw Greater Sydney go into lockdowns from late June, followed by Victoria. The current lockdowns will therefore see a sharp contraction in output in the third quarter. Returning to the events in the second quarter, there was a plunge in resource export shipments, also impacted by disruptions including maintenance work, and that removed 0.8 percentage points from activity. And net exports in total dropped 1 percentage point from the second quarter activity, and private non-farm inventories subtracted 0.7 percentage points. Domestic demand, though, grew by 1.7%, a touch above the original forecast of about 1.5%. Hours worked grew by 1.9% in the quarter, and consumer spending posted a 1.1% gain in the second quarter, in line with expectations, only slightly down from the 1.3% in the March quarter. Component-wise, spending on retail items came in softer than the retail surveys had suggested, and it was offset by stronger gains around vehicles and services spending. The household savings ratio declined to 9.7% from 11.6% in March. That's a bit milder than many expected, but it's mainly due to a firmer than expected income side rather than restraint around spending. Dwelling activity advanced up again, of course, 1.7% over the quarter, continuing the upswing and a result stronger than perhaps was expected. Business investments advanced by up to 2.3%. That included a rise in equipment spending up 2.4% as businesses responded to the rebound in activity and, very importantly, by the tax incentives. Public demand remains a growth engine, up 1.9%, with a focus on health spending in response to the pandemic and increased investment, another element in the stimulus package. So once again, you can see that whilst this number may look superficially reasonable, given everything, there are definitely storm clouds ahead. And some of those improvements last time around will not necessarily be replicated ahead. And of course, that iron ore price is still significantly lower than it was. On the other hand, the fact that we're shipping in more vaccines than we perhaps might have expected, and certainly more than last quarter, might weirdly lift performance. Although momentum in the property sector does appear to be easing back, and that might offset other retail consumer spending, which may also be somewhat down ahead simply because people are locked down and the level of uncertainty has risen. Actually, if you look at the confidence indices from Roy Morgan, which came out yesterday, business confidence troughed and consumer confidence is still grinding along. So, is there much to see here? No, not really. To my mind, the next quarter will be the critical one to watch. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.